I'm Ronnie MacDonald, Professor of Macroeconomics and International Finance at the Adam Smith Business School. Throughout my career, I've specialised in issues relating to international finance, particularly currency issues and currency regime issues. I've advised the International Monetary Fund, the World Bank, the European Commission, many central banks such as the European Central Bank, the Reserve Bank of New Zealand, and so on currency regime issues. And I've also advised governments on how to set up a currency regime and what that currency regime should look like. Where I'm coming from and where I've always come from in the independence debate is as a professional economist. I spent my career, 30 to 40 years, studying currency regimes. It seems a very narrow area, but there's a huge, huge literature in this. And when I started back in the early 80s in my career, little did I realize that this issue of currency would be the defining issue for an independent Scotland. And for me not to say the truth and what is going to happen would, I believe, be a dereliction of my duty as a professional economist. Macroeconomic policy, or the macroeconomic framework, means two important things. First of all, the fiscal side, which is taxes, spending and borrowing. And on the monetary side, it's the money that is in the economy to facilitate transactions. It's the setting of interest rates, and crucially also how your currency relates to other currencies, which we as economists refer to as the exchange rate regime. Is your currency linked in a fixed way to other currencies? Does it move in relation to other currencies? Is it floating, is how we would describe that. And for example, in the UK, since 1973, sterling has been floating relative to other countries' currencies. By that, we simply mean that if there is a shock to the economy, be it pandemic, be it Brexit, be it a financial shock, the exchange rate can move and alter your competitiveness so that employment is maintained in the economy, jobs are sustained in a way they wouldn't be if you didn't have that ability to adjust your currency. What helps us in terms of our monetary policy in the United Kingdom is that we have the ability to create money, which is very, very important. Obviously, the creation of money can lead to problems if it's not a credible policy, which some countries have got caught out by. But we have had much stability in the UK because the Bank of England has a very credible record of issuing money without causing inflation. So that has been a very important aspect and important strand of our economic policy making. And that has been very important in allowing countries to borrow funds at very competitive rates in international markets. And of course, that has meant we've been able to, during the pandemic certainly, support very large fiscal deficits, which otherwise would not be possible if we didn't have the ability to issue our own currency and set our own interest rates. When we don't have a crisis, because of the Bank of England's long history of credibility, over 300 years of credible performance in international financial markets, we've never had a default in this country. So interest rates are lower than they would be in, say, a newly minted country. But also in non-normal times, if I can put it that way, in crisis times, the power of having an independent central bank with this credibility has shown to be very important, both in the UK and in other independent countries. Prior to the 2014 referendum, the SNP were proposing that Scotland's currency regime should be one in which we retained the formal monetary union with the rest of the UK. So since 2014, moving forward, the SNP are now proposing to hold sterling in an informal way. So rather than being part of a formal monetary union, which means that you would have the support of the Bank of England in being able to support any banks which were in the Scottish jurisdiction, you would now not have the ability of them to support any Scottish-based banks. If there was, say, a run on the banks and people demanded more cash, the Bank of England wouldn't be there to create more cash in the current proposal of holding sterling informally. So an important aspect of sterlingization, or using sterling informally, is that you don't have your own currency. You don't have a separate currency, and you have no ability to adjust the external value of your currency, say by depreciating it, making your goods more competitive. Now, this matters big time in an independent Scotland, because historically Scotland has been running with a balance of payments deficit of around 10% of its GDP. That's a big number. It's £16 billion per annum. And basically, as an independent country, you're responsible for that. Now, there is a recognition, I think, in the SNP that in order to address that problem, you will have to have a devaluation of your currency. But what they argue is that we can go into independence, day one of independence, we can drift along happily using sterling, and then at some point we have to redenominate into a new currency, which would be, they now accept, at a devalued rate. But this begs the question, would financial markets find that an acceptable policy? And by financial markets, I mean that an independent Scotland on day one of independence is going to have to borrow fairly large sums of money, because we know it's got a large fiscal deficit. And so it's going to have to borrow on international markets, as other countries do. It's a perfectly standard practice. But if you are saying to the person who's going to lend to you that you're going to have to devalue at some point, then why am I going to lend you money when there's the expectation that I may lose a significant chunk of my lending to you? And it is a significant chunk, because with the kind of balance of payments deficit that an independent Scotland has, you're talking, in my view, of a devaluation of 20 to 30%. Now, these are big, big numbers. They're going to affect people's wages, they're going to affect their mortgages, and so on. Now, the important thing here to recognize, and this is the key thing that the SNP are not telling the public, is that financial markets bring events forward. Because if I am expecting to lose 30% of my investment, I will only lend to you at brutally high interest rates. I want to be compensated, and I also want to be compensated for a default risk, because there's a real danger if you are running a regime which is not credible to international financial markets, that you will have to default on your loans. And that, again, is a very serious matter. So interest rates in an independent Scotland from day one will be extremely high. And obviously, an independent Scotland could not afford to pay these interest rates unless it was to adopt massive austerity policies. So what this means effectively is that the crisis will be brought forward to day one of independence, if not before, because then there'd be huge capital flight in the transition from day one of the vote for independence to the actual independence process. Now, although the SNP, I think, and Andrew Wilson is now saying that they recognise that it would be costly for Scotland to become independent, and he is now, I think, recognising these issues of redenomination, which is good. And he argues that the costs will be worth it, because he argues the benefits will outweigh the costs in the longer term. It's for those who propose independence to say what the potential benefits are. I've yet to see anyone argue what these potential benefits are that can outweigh the massive costs that an independent Scotland would suffer on day one of independence. I think the bad news would be for people who were, say, in the public sector in Scotland, and there had to be this redenomination. There is no doubt that their pensions would be redenominated into Scots pounds. And so they would be, clearly, they would be devalued also. It's obvious why the SNP do not want to talk about the redenomination issue, or do not want to explain the reality of what is going to happen on day one of independence. So to take this down to the individual household, let's think of a concrete example. The husband and wife are both working. They're funding a £300,000 mortgage, say. They perhaps have credit card bills of £5,000, for example. What's that going to do to them? Well, both the mortgage and the credit card will be denominated in sterling. So obviously, if you have to move to a separate currency at a sharply devalued rate, you're going to be paying 30% more for your mortgage and for your credit card bill. It's a huge amount of money. And obviously, it's unlikely that wages are going to adjust in the short term. What is most likely to happen is you would also have a big inflationary kick from such a big devaluation, which is going to further erode your purchasing power. So if we can call it the average family, the average working family, this is really a nightmare scenario. If you don't let the exchange rate adjust, then you have to do what the Greeks did during their austerity program to stay in the Eurozone. They could not adjust the external value of their currency. And so they had to face what economists refer to as an internal adjustment mechanism, which is austerity, selling your assets, and basically cutting wages. So you've got to adjust internally. You've got to cut wages. You've got to have massive austerity policies. You've got to sell the family silver, essentially, to pay for this. And that essentially is what the SNP's proposal of informal sterlingization amounts to. As some have put it, it's Greece without the sunshine. Capital flight is inherent in the SNP's proposal. And indeed, you're going to get capital flight under any regime. I think that's clear because everyone is going to recognize there will be a redenomination issue. You cannot avoid that. And as I say, trying to kick it into the long grass simply ain't going to work because it's not the way people behave in financial markets. People will start moving funds immediately. They expect Scotland to become independent, whatever the regime is. But I would argue that the capital flight will be much, much worse with an inappropriate regime. With all the unique linkages it's had, given the length of the political and monetary union, to unwind these would be horrendous. And there's no example, in my view, of such a developed nation with such close ties to a neighbour. There's no example of that. I think given the magnitude of the issues that we've been discussing during our talk, the balance of payments deficit, the size of the balance of payments deficit, the size of the fiscal deficit, I think any government that is realistic about independence and wants to make independence happen in a much smoother transition than what is being proposed at the moment would need really to start preparing now, or at least on the day after a vote for independence came about. Because essentially you would need to have a smooth transition, you would need to deal with your balance of payments deficit. It would be critically important. And the only way you could deal with that would be to shrink the economy, basically, to have austerity policies which made your goods more competitive and reduce the imports into the country.